Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Futures on Wall Street cratered as these sweeping tariffs were announced.
We start sharply lower for the Nifty. We get to the first big support zone, which is 22. I mean, it comes in at 22,867.
Talking about tariffs, you'll want someone to come in there and bat for the bulls.
This is not a good policy. This is a very bad policy.
And 23,180 is where we are at. It's 150 points lower.
Tariffs are going up not only for India, but tariffs are going up for other countries.
I said more than 1%. I said 1% because of investment getting delayed.
With the increase in tariffs, how much inflation is going to be there in the U.S. economy? And
Nifty Sensex down close to about 1/3 of a percentage point. The Nifty's at 23,280.
Tariffs are a part of an overall Trump agenda.
Lower, but we're still quite resistant today, especially, the mid-cap and the small-cap end of the market. It has not fallen as much, so that bodes well.
Okay, it is a very, very decent response to what was not kind or nice last night. The market here holding on, market breadth is positive and things are looking pretty all right, just like any other day, I dare say. This is Closing Bell. We're coming to you from the CNBC-TV18 Moti Rosewal studios. I'm Prashant. With me, my colleagues Surabhi and Rima here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. It's looking all right just for us because Asia closed in the red. Yeah. Europe is down 1.5%, and the Dow futures is still down 1,000 points.
I don't want to be sort of the negative person out here, but I just have to place this on the record as well, on the table, that I think what we've seen today is the first order effect. And India is not that badly hit in the first order effect. And, a lot of conversations since morning have established that. It's the second and third order effects, and we'll talk about that as we go forward. I was looking through a Morgan Stanley note before coming to the studio. They are talking about a certain number of basis points being shaved off FY26 growth targets, not because our exports get hit, but because of the other issues that would be coming in place. So I think today is fantastic, but is this the worst being over for our markets?
So the second order impact is being felt on IT, right? IT is not directly impacted, but on the back of this indirect impact, global economy slowing, the Nifty IT index, Nigel, is down 4%. So that's a clear case of the second, third order impact that we've just started to see.
Well, that's right. But pretty good times, right? If someone told you at the start of trade that you'll have the mid-cap index wave in the green, 3 stocks advancing for 1 stock that's just declining, and you'll have the Nifty bank that's up close to around 225 points. You're definitely taking that. That said, I think, Prashant, you want to do a quick recap of what's happened so far?
No, I mean, it's been good, but it's day one, right? And it's just getting baked in. There are still talks about calculation, 26%, 27%. So we're still kind of, these are still pretty fresh in the minds of many people. I mean, it's instructive. A few sort of people that we spoke with through the course of the day, and these are not market participants, but on the trade side, I mean, they were unaware of how the calculations were done. So people are still, in a way, I mean, because we are doing this day in, day out, minute by minute, we're kind of on top of what's happening. But in terms of the real impact, I mean, I think that will seep in slowly and steadily, and it'll start to show up as well. So with that kind of sort of short take, let me just quickly welcome in our guest. Samir Arora is now joining in, founder and fund manager at Helios Capital. Samir, good afternoon. Great to have you with us here. Thank you very much. This was worse than what anyone thought. Although at the margin here, the narrative became that, well, others are taking a hit larger than us. So for some sectors like textiles, etc., it may not be that bad. Positive, I don't know, but maybe lesser hit in that sense. What is your own perspective, Samir, on the overall situation?
Textiles, it is not the first thing in a big picture sense, although, in our long only fund, we are fully invested and all that. But I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze a stock, but whether that day there is net selling or not by FIIs. I think beyond a point, just because if today they have not come in or there's a slight match or mismatch of these two, then the market is up. But it just looks a bit too much because my general thumb rule is that you can't suddenly negatively surprise either in a company results or in macro events. And within 10 minutes, say it is discounted because now it is known and it is bad, but it is the worst that we can be. These things take time in real world. And to just discount everything in 30 seconds is a bit much. Although big picture, we are very happy that our long short and both these funds are sort of playing a bullish stance. But this still looks a bit much.
You mean the resilience? It looks a bit much.
Yeah.
Tariffs also look
too strong. It's a bit too strong. You suddenly can't go from an expected 10% type tariff to 26% type tariff and say it doesn't matter. I think it can be handled. But the market is assuming everything. For example, I saw on your channel and others that India is about to do an FTA with US and it will be done by year end. Year end is 9 months away. So for these 9 months, these tariffs will remain, right? You can't say that, okay, because we'll be negotiating something today, only give us our waivers or, give us a lower rate. Also, I think these second round effects and third round effects, first of all, we have not seen European response, Chinese response. Tonight should be Canadian response. And then US, that is Trump and Scott Bessent have already said that please don't try and do reciprocal tariffs on my reciprocal tariffs because that might aggravate the situation. I think we can wait 2-3 days and see how this whole thing goes to second and third round.
There was Neelkant Mishra who was with us in the morning, and he was saying that the way this impacts economy-wise India is not that much, but the impact will come from higher equity risk premium. And he was generally broadly saying that this is it's going to linger. It's not done, and I think that is your view as well. But broadly, beyond that, what is your view? How does this seep in? How will it show up?
From an economy point of view, it's not a big deal because we don't have big scale of imports and exports. So this thing is that we need to import additional $30 billion. How? If we assume that formula is what it is, India is exporting some 90 billion, importing 40 billion. So the trade deficit is 50 with US, divide that by 90, that is broadly this number. So to bring that 50 billion down, you have to bring it down to 20% type number because then you get 50% discount and your tariff is 10%. And there's no need to go below that because that is the minimum tariff, which I guess will continue for 4 years for sure. So we have to reduce deficit or import more $30 billion. And it's not a waste of $30 billion. You're not saying, extra thing we have to do. You have to substitute something here, something there, maybe 10 billion of oil, 5 billion of cars, and the rest 15 billion the government can figure out. But these are the too easy to do things that can be done. But basically, you need to somehow show a path, or I don't know whether they want to see actual numbers or just a path to see this going down to, 20-odd% deficit as they have defined it.
Samir, hi. Afternoon. Rima here. What does an emerging market investor do? Now, he's grappling with 34% on China, 36%, Vietnam is 46%. What is the call foreign investors are taking now when it comes to investing?
I think 5-10 days, somebody should wait. I also don't believe that Vietnam will remain at 46% simply because they have already officially announced, not proposal, they have officially announced that the tariff for US goods is going to be 0. They've already put it out there. It's just that because the current numbers are such, Vietnam does not have the ability to import much from the US, but they can easily say that you please send us whatever our guys can buy, just that they can't buy. But the tariff is 0. Then what do you do? I think they will go to 10% by 9th April is what I think. So please don't, because you see, they have said means, I don't know whether legally what is the word, but it's public and known that they have made it 0, just like Israel has made it 0. So these other countries can go all the way. It doesn't matter to them. There is not much you can, they can import anyway. So that's not their fault. So Vietnam will be out. China, my thinking is that China is not going to accept so easily. So what if they say that for things that US needs, let's say bulk drugs, we put an export tax. They can do any of these things because if you put tariffs, so what I'm saying is, every investor, including me, who is actually fully invested more or less, 4 or 5 days, and let's see at least for 30 seconds.
Yeah.
You're not going to miss a big rally. That's all I can say.
No, absolutely, Samir, take that point, and this is what we've been discussing since morning, right? That it's not just about that tariff number that you can match. Vietnam will cut, India can cut, all countries can cut. If it's about trade deficits, which the US is running, then it's a much bigger issue.
No, I think India and all can't easily cut to zero, no, because there are so many, because it's a bigger country, so it's not as small. But for Vietnam or something, they can say, what should we do now? And that I think those may accept.
No,
otherwise, the same things will come from China plus Vietnam. They might as well promote Vietnam at the expense of China.
You know, absolutely. The reason why the US is running such large trade deficits is that it's more cost effective to produce those products in a Vietnam or in a China or in a India. So that's a much larger issue that we'll wrap our heads around. Anyway, now coming to India, we'll pull up some graphics in a bit. I was looking at a Morgan report, lots of estimates doing the round on what the numeric impact on us is. So most people are saying maybe 30 to 40, 50 basis points shaved off this year's growth. That's direct impact because of our, small exporting segments that we have, electronics, etc. Everyone is more worried about the second and third order impacts. Morgan Stanley, for instance, is saying that it could actually delay the invisible private sector capex cycle even further. Because how do you invest when you don't know what where the trade lines are, where is your supply chain, should you look at US as a key market or not? So it pushes back private capex. Yes.
Absolutely correct. And also, as soon as US signals that these things are the max tariffs and now they can be negotiated. Obviously, every company will assume that my government will negotiate downwards, and there will always be a plan that that government will have. So the investment into US also will be delayed. Everything will be delayed by 4-6 months. And in our case, the other issue is IT, which, by the way, I've been saying for some time now. But IT is, Rima was saying IT is a second order effect or third order effect. Actually, IT's impact will be a fifth order effect. Because if IT is not strong, what does that mean for our consumer and other things? And other things. So what I'm saying is, it is uncertain. India is at a relative advantage. But also, if the US market, for example, let's say does not fall much, because we accept it, obviously US will put more tariffs on sectors now, because they will feel comfortable that the world has accepted it, because they have already said that they want to put sectoral tariffs, which they've done on auto.
Samir, so coming back to my simple short question, because of all the complexities, because of all of these complexities, would it be a little foolhardy to assume that the great Indian bull market had begun again? March, we had a good month, and people wanted to believe the worst is over. Bull market chalu. Would it be wrong to assume that?
No, relatively it is over. Absolute depends on what happens to the world. So my logic is, first of all, next 4-5 days, so somebody should just relax and see his conferences and press conferences.
We can't relax, no, Samir.
We have to report morning, evening.
Beyond that, you have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it, and maybe not be up in that period, but at least it will be dignified and you will get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money, you may lose less, you may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US. So you don't want to be at that stage where you think that US will fall a lot. But
so 8 to 10%.
We are outperforming. It's a relative bull run. One day it will become an absolute bull run.
Yeah. I like it in a dignified way. Hindi में तमीज से थोड़ा 8-10% घट जाए.
हम थोड़ा इज्जत से गिरेंगे.
Just Samir, on just a quick word, right? You invest in other markets, etc. So what is the behavior of the point that Rima said? Eventually, I mean, does money go back home in a situation like this, which is US, go into the dollar?
I don't think it will go home. This is a serious change. And, like I sold mostly everything in the Feb month and a little bit in early March, but I have not felt even to buy 1% back in US, not even 1%. Also, by the way, look at it. If Europe has said it in black and white yesterday in their press release that they will be targeting US services, because they understand that US has services surplus. And so they are saying we will target US services. US services means what? That means you have to target Google and Facebook and all these kind of guys. So this will be messier than normal. And so right now it's too early to buy. Of course, people in US will do some, just like we keep doing in India, a little bit of plus minus. But overall, what I'm saying is it's too early to even celebrate, although relatively today is a great day. And yesterday was a great day. But I'm saying let's not jump in. That's all. There's nothing.
As nowadays the youngsters say, everything is about vibe. The vibe today is one of not jubilation or celebration. It is confusion.
Relief. No, somebody you can say it's relief. But I'm saying it looks a bit, fishy. If things go completely unexpected and still the market is okay. It should. That's what I think.
Correct. No, absolutely. On pharma, Sameer, do you have a view?
See, pharma clearly has relatively benefited and in absolute also benefited. The only thing is that Trump has said that he wants to have 5 sectors in US, which he wants production there, manufacturing there, whatever. So if he has some sectoral tariffs, I don't know. But otherwise, obviously, it's relatively escaped and in absolute also escaped. So that way, it is justified for that to be up today.
But Sameer, finally the question is कि करना क्या है? You're saying 3-4 days do 3-4 days. Okay, chalo 3-4 days. You're saying don't do anything. Just watch this, understand it. Beyond that.
So बाद में it depends. As I said, if the US has escaped it, it'll fall for sure. But it doesn't fall apart. Then this emerging market flows will come. Somebody will go and explain that India has outperformed. India is this. We will say we have less intensity of exports and our exports, the total absolute amount that we need to do is $30 billion. And in 5 minutes, you can make this thing that 10 billion you can import oil, 5 billion you let cars come in, which will be about 3% of India's car volume. If you say 5 billion divide by say $25,000-$30,000 per car, so you can import 150,000-160,000 cars. It is just 3% or 4% of India's volume. It doesn't change the world. So you got 15 billion covered. Another 15 you have to find here, there, something, and you can say, hello, my deficit is down. Story over. It's not a big deal if you have to explain it. But if in between they say, but US is down 15%, what is the secondary effect of that? Then it becomes very confusing. Also right now, since IT is doing badly and consumer large companies are doing badly or not doing great, we are left with financials and a little bit of my food delivery type high growth companies and a few here and there. So that universe should expand a little bit. It just needs a little bit of time, I think. Just give some time so that a new story can be firmly in place rather than just saying it didn't fall today, therefore the bottom must have come. That's all.
So while we're making the narrative over the next 3-4 days, Sameer, is there a case to sell today and watch the dignified decline from the sidelines?
No, I don't know whether it'll decline, but what I'm saying is we must see not 3-4 days also, it could be 2 weeks also. What I mean is,
so why not sell today and watch, right? What's happening? Is there a case for that?
Well, we have shorted a little, but we are not selling anything now that we have come in, absolutely distancing ourselves from IT and from these zero growth companies and anything to do with US. Please understand the risk right now is not India like it was 3 months ago. It is what happens to the US and its effect on India. I don't think the effect is on direct India. It is what these policies mean for US in terms of inflation and other things. Today, I think JP Morgan or somebody is saying 150 or 125 basis points increase in inflation. Right now on Bloomberg, I saw somebody saying no interest rate cut this year. It's all going to be driven by US now. So we have to see that market and then react. But I'm saying first day, we can't be jumping with joy, even though one more day has passed without paining us. So that is good.
All right, Sameer, absolutely. So we will wait and we will come back and we will chat again. There'll be many conversations over the next many weeks, months. As this story progresses, April 9th is that day, right? You said Vietnam, perhaps tariffs go to 10%.
No, I'm not saying that, but I'm saying logically.
It's possible, yes.
It could be, or maybe a few days later, it could be. Yeah. Because now they have no tariffs, then what can you do about that?
Correct. No, absolutely. Although there are other longer discussion we can have is what the tariffs itself are not reciprocal, actually. They are based on the size.
But they are a good summary. By the way, they are a good summary. I saw on Twitter, which is a good thing. You can also try. You put this formula on Govt and on ChatGPT, and it says very good formula. Actually, it is a summary. Instead of saying how much is your non-tariff barrier, what is your policy on this sector, that sector, you say in aggregate. If
You are-
So you're saying they've got on ChatGPT to arrive at these tariff numbers, Sameer, on a lighter note. On a lighter note.
sorry, what?
No. I was just joking. I was
Samir
wondering.
is embracing AI and Grok.
It's AI, Grok, ChatGPT. That's how they've arrived at this glorious number of 27%.
For sure. They must have said, give us a good, easy number.
What's a good tariff for India? What's a good tariff for Vietnam? Okay, chalo, let's go with this. All right, Sameer. We really look forward to more conversations. We, of course, need much more clarity as this juggernaut rolls on. Thank you so much for joining us this afternoon. Okay, on that note, I think we have to take a quick break. Yeah, we'll do that. Market's still down about 80 odd points on the Nifty. Take a break. We'll come back on the other side. We will have Pathik Gandotra and Gurmeet Chadha joining in to talk about the market verdict after Liberation Day.
Welcome back. Well, from the broader markets, a couple of stocks actually are cutting their losses. Naveen Fluorine, I recall earlier this morning, it was down close to around 5%. That's down just 1% or thereabouts. So good recovery is what we're seeing on that one. Pfizer is another stock that's seen a good recovery in the last few minutes. And Tata Communications, well, that one has spiked to the high point of the day. So good going on some of these names. But let's focus on the markets yet again. We have Pathik Gandotra, partner at Drone Capital Advisors, as well as Gurmeet Chadha, managing partner and CIO at Company Circle, who join us in the conversation. Hi, gentlemen. Thanks a lot for joining in. Pratik, let's come across to you first. What do you make of what you heard from President Trump overnight? The tariffs now have been announced. All eyes on whether or not there is some renegotiation and negotiation. But how are you placed currently? What would you do? For the time being, we're celebrating that the Indian markets have done a relative outperformance. But are we calling it too early?
The Indian markets are obviously outperforming because we have been better placed on a relative basis vis-a-vis all our competitors. China is anyway, I think, out of the race because it has issues other than just trade with the US. And with the other near-term competitors in various sectors, you find that India has had a relatively lower tariff. Second point, it appears that these tariffs are based on not absolute duties, but absolute quantum of trade deficit. And so given the fact that, say, countries like Vietnam, Bangladesh, etc., smaller countries which compete in some of our sectors, apparel, say, for example, they will not be able to bridge this gap on a sustainable basis because they physically can't do it, whereas India can. And so we have a chance to build on these duties and to try and reduce these duties on us and are at an advantage on an absolute basis right now. And also going forward, we can have a stronger advantage over them. And so obviously, I think we are at a very, very significant advantage. You may have obviously near-term issues about a sudden increase in tariffs, obviously hits contracts as they are live. So there may be some volatility in margins, etc. But overall, I think it's a great opportunity for India to at least significantly improve its share in the worldwide in the labor-intensive sectors.
Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is also with us on the show. Gentlemen, afternoon. Gurmeet, what have you done today? There's not been too much volatility, surprising, but have you made any trades?
Not much, Rima, to be honest. I think you have probably seen the second leg of this. You can probably divide it into 4 parts. I think the third leg would be when the negotiation starts, and if they don't do, retaliation happens. We'll have to see how China does, how Europe does. There's that clause 4 in the executive order where a lot of countries will try and negotiate back in terms of the relative tariffs. So for now, I think pharma clearly stands out. I think that's been exempted, but you don't know how things pan out. So I think we've added a little bit of branded pharma. We added some CDMO names in the portfolio. We have Mankind Pharma, we have Laurus, we have Newland and Hikal. So we have a decent healthcare portfolio, and we have been overweight on it for a while. So that's helped us. We are continuously looking at more domestic consumption stories right now. I think banks will gain with bond yields falling, treasury incomes going up. That will offset the NIM pressure. And then you have an RBI policy on 9th as well. So Bank Nifty obviously has also done well from relative lows. And we are looking at some travel tourism plays. So we are right now adding domestic consumption and bit of financials and pharma. And wait out for 4 or 5 days. I agree there could be some opportunities which will come because the relative tariff on Asian peers is far higher. And if India is able to negotiate well over the next 4 or 5 days, a lot of opportunities may emerge. But for now, just wait it out for 3 or 4 days, 1 day at a time.
Absolutely. I mean, that's exactly what Samir was also saying, that there's no need to fire the gun immediately. Sit back, observe, see what's going on, and then decide what's the best course of action. Take your point, Gurmeet. By the way, let's look at some of the textile stocks, and they're soaring. They're doing really well in trade today. Arvind, Gokuldas, and Trident. And if you'd wonder why, given the 27% tariff on India, that's because others have been taxed a lot more. Our major competitors in textile and apparel, which would be Bangladesh, Vietnam, and countries like Sri Lanka. So let's go across to, I think, Vinny. Vinny is now standing by to give us a better perspective on whether Indian textile makers actually stand to gain. Vinny.
So absolutely, when you look at it in terms of a tariff that's charged on India, 27%, it seems like a lot. But versus the other countries that we're seeing, whether our main competitors, Bangladesh, China, even Turkey, Japan, Taiwan, the percent that is charged to them is much higher. So yes, versus the other countries, we are charged much less, and that turns out to be a bit of a benefit for all these companies and exporters in India. Now, we had a note that came in from Prabhudas Leela this morning as well. They said this tariff will actually give an edge and an opening for India in terms of an opportunity in the US market, because other countries would become much more expensive. Currently, in terms of textile exports as well, the shipments that are made to the US is totaling to around $2.8 billion in FY24. And the share of US apparel imports for India as an import country is very less. India is just 6%. When you look at China, 20+%. Vietnam around 20% as well, and Bangladesh is around 9%. So yes, our share in the apparels is also very less in the US market. So not much of an impact that comes in for us, but it becomes an opportunity because then they would want to increase the share. The 6% could further increase as an opportunity versus China, Vietnam, and Bangladesh. Now, other than that, what Prabhudas Leela is highlighting is that Indian exporters, a relief tariff advantage would come in, enhancing the competitiveness by around 10 to 20 percentage points for the Indian players in the industry. Arvind Limited, when we spoke to them earlier as well, they said that they expect these new trade agreements that are going on in the market in US and UK to be a bit of a benefit. Bilateral trade agreements will come in. That is more exciting for Indian textile industry, as well as the Indian textile industry will now look at a more holistic approach, especially for the Western market. So a positive cues that are coming in for the textile front, despite this 27% tariff.
Got it, Vinny. Thank you very much for that. Let's take this conversation back to our guests. Pathik and maybe Gurmeet, I mean, if either of you or both of you can comment on this. Textiles and apparel as a space, I mean, these stocks have not dominated market imagination for obvious reasons. Individually, yes, these companies have been doing well. Gokuldas has been one of the biggest exporters for a long time. But perhaps it was a bit of an opportunity lost in the last 20 years because other countries, were way ahead of us in the race. So now is it a case to relook at some of these mid-cap or even small-cap textile and apparel exporters? Gurmeet?
So, Surya, I think we should wait for the end consumer demand in US to pan out. While relative tariffs are lower, but if the end demand, sees a slowdown, it won't affect. So Gokuldas is more uniquely placed because 80% is US exports, and they also acquired one plant in Kenya about 6 months back, where the tariff is 10%. So there, the effective tariff for their acquisition, they did one in Middle East, and now, would be relatively lesser than even, let's say, whatever the rate is, which is around 25, 26%. So that's an advantage. KPR Mills also, to a certain extent, is fully integrated. So you have to be a little selective here as far as, textile goes. So if you see, for example, Vietnam is 46%. Even Thailand, Indonesia are mid-30s. Bangladesh is pretty high. Bangladesh was something where India and Gokuldas competed on a lot of things. Gokuldas does these labels called Superdry, Adidas, Puma, the Merchant Navy, Indian Navy brand in US. So I think Gokuldas in particular, post the change in management, has done well. But I would wait out for, if the US economy, let's say, broadly goes into a hard landing or a recession, then these things don't really add up. It could be right now more a reaction, more to do with the positioning of the stocks rather than anything else.
Yeah, I guess that's why they say that ultimately you cannot take away that big line, right? When the US catches, or when the US sneezes, the rest of the world catches a cold. So while there could be an opportunity if US consumers aren't buying, then really what are we talking about? Got that point. On pharma specifically, I think what would your call be? Would you still be wary of companies that have a big exposure to the US market? Or are you happy to own those names, who are far more dependent on the US sales?
I'd like to add to Gurmeet's point. Just one point I want to add before I comment on pharma. See, the US demand, I guess, obviously will be optically, it looks like will get impacted because of the tariffs. But also remember that the president has said that he will cut taxes across the board. And numbers of around $400 to $500 billion in tax cuts is what they are thinking about. So if those tax cuts come, it's like you populate one pocket and take it out of the other pocket. And so all those things are also material to figure out as to what demand will be. And I agree, you have to wait. But the picture isn't as sordid as it appears. That's my point on April. Second, pharma, I think, given the fact of the criticality of medicine, and also the fact that there are not too much of capacities which are coming up in the US, I think the pharma sector will be dealt with leniently over a period of time. So I would go out and look at decent companies in the CDMO space, and I would agree with Gurmeet as to what he said, that look for good quality names in the CDMO space, which have firm contracts with large majors, and those would be very interesting. I would not obviously go for just normal exporters because, who just export generics. I think CDMO is a more preferred space.
I think Samir was just telling us that he will absolutely stay away from the Indian IT space. In your portfolio, do you own Indian IT? And now what would the approach be?
No, I don't own any IT. Absolutely zero.
All right. And the advice would be continue to stay away.
Yeah, I mean, we look at, actually, it's not specifically about the IT sector at this point in time. We do look at companies from time to time. We are bottom-up focused. We don't mirror the indices or anything. We don't look at large companies in any case. And so, I mean, I'm not the right person to answer the question.
Okay, all right. We'll leave things there. Gentlemen, thank you very much. We'll have, this is, I'm assuming, the first of many conversations, and the word tariff isn't going anywhere as much as we like it to be. So thank you very much. Gurmeet and Pathik, appreciate your time here on CNBC-TV18. Just about 30 minutes to go, 28 to go for the market close. Last 30 minutes coming up. I think we'll take a quick commercial break here. Well, there's always chatter in terms of specific stocks, in terms of what's happening in dealing rooms, and Nimish gets us that on the other side.
Welcome back. We are, of course, analyzing all the key developments of the day, including the impact on India when it comes to these tariffs. Just very quickly, I just want to summarize what Morgan Stanley has already put out. Their economist, Upasna Chachra, has put out a note already saying specifically in terms of numbers what this means for India. So they're saying that their original estimate for growth was 6.5% for FY26. Now Morgan Stanley is shaving off 30 to 60 basis points from that growth estimate. And the issue is they're saying the direct hit is not that important for India. It is the second order effect, which is far more concerning, where they're saying that this whole uncertainty around the business environment will probably dent corporate risk appetite, and therefore it will further delay and derail and push back the private sector capex cycle that anyway has not been showing signs of taking off. And then there could be a risk of even deeper monetary policy cuts than what has been anticipated at present. They're saying the government in that case will have to perhaps step in. It will have to stop its fiscal consolidation, thought process or roadmap and start pump priming the economy with further capex spending, basically a boost of capex spending in the worst case scenario. So coming down to the numbers, they're saying that the monetary policy stance is expected to remain supportive. In fact, they're expecting a change in the stance to accommodative on the 9th of April itself. 25 basis points rate cut is also expected in the April policy. So expecting on all hands on deck, as they say. That's the Morgan Stanley view. Now, what is the Indian government's response? There is actually, a statement that has come through. We have Abhimanyu joining in to tell us exactly what the government of India's official viewpoint on this is now.
Post-announcement of reciprocal tariffs by the US president, the Department of Commerce has issued a statement saying that it is assessing and studying the situation and is also engaged in consultation with stakeholders. It's taking feedback from relevant stakeholders, which include traders, exporters and manufacturers, and is going to calibrate its further decisions based on the consultation itself. Also, it has noted the imposition of additional ad valorem duties ranging from 10% to 50% on imports from all trading partners of the US, and a baseline duty of 10% would be imposed from the 5th of April, and the remaining country-wise duties, that is the additional ad valorem duties, would be effective from 9th of April onwards. The total duty which is going to be imposed on goods from India is going to be 27%, that is 10% baseline duty plus 17% ad valorem duty. It remains to be seen how the situation is going to pan out, even as India and the United States are already engaged in talks for the first tranche of a bilateral trade agreement between both the countries, in which both the countries are looking to not just increase market access for each other's products, but are also intending to grow trade, investments and technology transfers. Both the countries are aiming to double their overall trade and are also aiming to ensure that the first tranche of the BTA is concluded by the fall of 2025.
Okay, all right. Thanks a lot for that, Abhimanyu. Well, the markets are a little bit lower, but as we've been mentioning, the good news is breadth is good and the Nifty Bank is good. Let's get in Nimesh on D Street Chatter. Nimesh, I mean, very good performance, one would have to say. Yesterday, you thought that, we were preempting something. But today had a gap down, and that gap got bought into, and the breadth is something that's really encouraging.
So breadth has been positive for the last many days, right? Yes. So that's been the trend, and that shows that there is momentum and commitment now again in the broader market stocks. But as you rightly pointed out, a good recovery from the intraday lows. Bank Nifty is in the green. I guess there is a clear shift now happening from IT to financials. And what has helped financial today is that the Q4 updates across most of the banks have been quite decent and strong, right? So that's also helped at the margin. I understand even a couple of other banks which are going to report the quarterly updates are likely to report good numbers, the likes of Bandhan and also. Maybe that's the reason that all those banks are buzzing in trade today. Flows, again, it's quite mixed. I said yesterday as well, there was no big buying or big selling. That seems to be the trend today as well. There is no big commitment or a big sell-off, so to speak, from larger institutions again in today's trade. Technically, 23,800 is the level to watch on the upside. That's a level where you might see some supply coming in. But broadly, the way India market has bounced back, at least it suggests that there is momentum clearly, and there is no big selling happening from the large institutions.
Well, that's right. At least the broader markets and the outperform portfolios feel good, and it seems the interest is back in those names, which is heartening. What about individual stocks? What are you picking up?
So a lot of stocks are buzzing in trade, and there is a lot of chatter as well across many companies with regards to fundraising. I'll highlight a couple of them, but there are a few more as well. First one is Parag Milk. That's been buzzing in trade, good volumes as well. The stock is sharply recovered from the recent lows of 140 back to 180 levels, and now there is a buzz that maybe there will be a board meeting for fundraising very soon. It's likely that there will be a preferential issue, and even the promoters may participate in this fundraising. So that's a trigger in Parag Milk. The second stock is IIFL Finance. Again, that's from the recent lows. I've seen a bit of a pullback. There has been a lot of chatter with IIFL Finance as well. But I understand even there is a very high chance of a fundraising plan very soon in IIFL Finance. So that's the reason why that stock is buzzing in trade. I guess that's the kind of buzz for a couple of names like IDFC First Bank as well. Third stock is DB Realty. Again, a decent pullback from the recent lows, and the HNI activity is quite strong in the last many days. I understand some large HNI investors have started buying again DB Realty. And the last is a couple of stocks where this is delivery-based buying from larger institutions, JSW Infra and HDFC Life. Both these names stands out because after a long time, some sort of interest seems to be back. The stocks are flat, but I understand there is delivery-based buying, though it's price limit, but there is buying interest from larger institutions in both those names, JSW Infra as well as HDFC Life.
Okay, all right, got that. Nimesh, thanks very much as always for all the buzz and the chatter from the street. We'll quickly go back to Mitesh. I think we have him with us for some final thoughts and comments. Mitesh, so the roller coaster is leaving us about 74 down. Who knows what overnight news flow is going to be like. So final advice on the indices and any quick trades.
So, good afternoon, Surabhi. I think in the morning also I was saying that it is the Bank Nifty which will do better than the Nifty. And I think that trade is continuing. If you look at the structure on the daily, weekly chart, the Bank Nifty is much more stronger. And therefore, the focus should be on the banking index and some of the financial names. Nimesh was mentioning Bandhan Bank. I think that stock has given a breakout. December, we had some positions. We just booked part of it. That apart, I think, Axis Bank looks good to me. So as a BTST trade or even a short-term trade, I would be comfortable recommending Axis Bank. Buy here with the stop just below levels of 1,082 for a BTST trade. Look for a 1105, 1110 as the target for tomorrow and day after. And the other one is ACC, which is a BTST. It's closing near the day's high, so very strong chart pattern over here. ACC is a BTST with a stop below 1980 and look for a target of around 2015.
Okay.
All right, Mitesh, thank you very much for that. So those are some trades coming your way. GMR Airports is another one which we're going to talk about. Stocks up 3-4%. There've been some sort of broker commentary initiation reports, and this time it's Citi. Vivek is here to wrap it up for us. Vivek.
Well, that's right. So GMR Airports was in the news a couple of days ago after the Delhi airport finally received the tariff hike. Now, today, Citi has initiated coverage on the stock. They have a positive view. They have a buy stance, and they have a target price of 90 rupees per share for GMR. They call it an Indian airport pure play business. They say that the company is fundamentally well placed, where they see India's passenger volume growth at 8% CAGR from FY24 to FY27. They also say that the company's assets actually possess comparative advantages, especially when you're comparing it to the rest of the Asia-Pacific pack. The free cash flow cycle is turning positive for GMR, and one of the key triggers is the fact that Citi, along with other brokerages, are now expecting that FY26 will be a profitable year for GMR after a while. Core earnings for Citi stands almost 5 to 6% above street estimates. Along with that, they see FY27 EV to EBITDA at 18 times, and this is almost double the APAC average, given the fact that, and they justify it saying that the Indian airport business has stronger structural organic as well as inorganic growth opportunities. What will drive profitability for GMR in FY26? 8% traffic growth, 2.4 times increase as far as the tariff is concerned, especially in the Delhi airport, and 7.5% per annum increase in non-aero spending per passenger across all three of the Indian airports that GMR actually operates. That's Delhi, Hyderabad, as well as Goa. One of the top movers in trade today is GMR Airports.
Thank you very much for that. And one of the top losers is all the IT names. In fact, across the board, there is no respite, whether it's large cap names like TCS, HCL Tech down 3.5%, 4%, even mid-cap names like Persistent down close to about 8%. The problem is companies are trading at valuations higher than the pre-COVID level and growth is struggling. So that plate of the current valuations versus the pre-COVID valuation. We're comparing it to FY19 because post-COVID growth boomed. There was this entire digital transformation wave. Growth rates were much higher. Hence, we're going back in time to the time when growth rates were fairly muted. And currently, as you can see, large cap IT names are trading at a valuation premium compared to the pre-COVID level. So, for instance, TCS is at 24 times pre-COVID. FY19, it was close to about 22 times. Now, growth rates for the companies are going to be very, very muted. Now, I'm putting out the JP Morgan estimates for FY26, and you can see the growth is likely to be low to mid-single digit. In fact, closer to low single digits in FY26. They're baking in some amount of macro uncertainty into this, but no one knows the full extent of that. Midcaps is seeing a bigger knock today, particularly names like Persistent, KPIT Tech. One, because these stocks have done so well. Persistent has doubled in the last 3 years, even after the recent correction. And these companies had seen a very sharp valuation re-rating post-COVID. That's the number. So, for instance, Persistent, which used to trade 13, 14 times PE, is now trading at 45 times. At its peak, it was even closer to 50 times. A KPIT Tech at one point of time was trading close to 50, 55 times PE. And pre-COVID, these were all in their teens. So mid-cap valuations got re-rated substantially, and now that is coming off. Now, Jefferies has come out with a note as they assess the impact of Trump's tariff order. They say the IT sector is not directly impacted, but it can be indirectly impacted. And the way they're looking at it is sectors like manufacturing, retail, and logistics. These are sectors which could be negatively impacted by the tariff. So companies which cater to them, they have a higher exposure, could be negatively impacted. The second impact that they're seeing is that if US growth slows down, there is a possibility of Fed cutting rates. If that plays out, then companies with high debt on their books, so for instance, communication, these could positively benefit. And then you've got pharma, which is, escaped the entire, Trump tariffs. So they've put out the math about the companies with the highest exposure to manufacturing retail, and that will come up for you on your screen. So if you do all the second order impact of the affected sectors, they're saying Tech Mahindra, HCL Tech is best placed from a favorable vertical exposure. And in the mid-cap space, it's IKS and Sagility, because these companies get 100% of their revenues from healthcare pharma, which are completely unaffected. So IKS, Sagility, recent listings, they're sort of catering to the insurance companies, medical insurance companies. They cater to many of the hospitals, clinics, 100% revenue from the healthcare in the US. And these stocks have done pretty well compared to the pre-IPO prices. Amrish Baliga is now joining us on the show. Amrish, a quick word on IT. Did you own any IT stocks? Have you cut down your exposure? Are we overreading the impact?
No, in fact, once there was talk of tariffs, that is the time we started. We stopped buying fresh into IT. Whatever we had about 6 months back, we're just holding on, but we are neither sold nor bought fresh. And clearly, I think, with the expected slowdown in the US, I think the IT sector as such could get affected. But that doesn't mean that one has to really go out and sell off immediately, because I think it's better to wait and watch.
Okay, all right. Amrish, before we ask you a few more questions on a lot of stocks, I believe you have a pick for us. Varun Beverages is the one?
Well, I think the theme, at least, I mean, for the next 6 to 9 months, would be manufacture local and sell local. And Varun Beverages actually fits in, I mean, quite well out there, is not affected by tariffs. One of the largest franchisee of PepsiCo globally, I mean, outside US. And the India footprint is across 26 states, about 6 union territories. Around 90% of PepsiCo's India volume comes from Varun Beverages. And after the buyout of Bevco of South Africa, they've expanded in the African region and have clearly improved the footprint in the last year or so. In India, they have about 40 lakh retail touch points, and they're growing at about 10 to 12% out there. And the available retail touch points universe in India is about 1.2 crores. So I think there's a huge headroom still left. If you look at the carbonated soft drink category, about 70% of the total beverages is carbonated soft drinks, and the juice category is about 6% of the sales volume. Water is about 20% of their volume. And the main season actually starts with summer. And since summer has started and the weather report also indicates that the summer will be severe with heat waves, it should be positive for Varun. Generally, the energy drinks consist of about 14 to 15% of the total beverage market. And here, their brand Sting energy drink is about 72% of the market share. Expected revenue growth is about 20% CAGR over the next 3 years. PAT CAGR, I'm expecting about 25%. So expected EPS is around 12 rupees for calendar year 26. They don't follow financial year as calendar year. So the target is about 660.
660 on Varun Beverages, and that would be your preferred pick. Completely take your point, Amrish, that, this is very much the time to look local, invest local. I guess we don't have to worry about the global headlines. But speaking of local and speaking of consumer, Dabur. So what's going on here? I mean, clearly you're not negative on overall consumption, which is why your pick is Varun. But look at what Dabur is saying. I mean, they're talking about a margin fall of as much as 175 basis points. They're saying that the India FMCG business will decline in mid-single digits. Stock is down 6%. Your thoughts?
No, I mean, see, I think the management is, being too cautious at this point of time, and also to a certain extent, they will also get affected. As far as the US sales is concerned, because the huge Indian population there also buys the Dabur goods. So I think that effect also would be there. So both these have, in fact, made the stock come down by about 6-7% today. But then I think it's a buying opportunity because if you're talking of, at least a year plus, I don't think one can go wrong with with the sort of a market and consumption where Dabur is. So I think this is a good time to start buying.
Got that. Amrish, do stay on. We still have about 10 minutes of trade left before we can wrap this trade. As we get into a break, here is some good news for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, our articles, financial world updates at your fingertips. Download the app now from the Apple or the Google Play Store, or you could just scan the QR code on your screen.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of changemakers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back. Well, the markets are holding with that card, but I'll tell you what, I think you need to turn your attention to the dollar index. That one slipped below that 102 odd mark. At the start of today, it was hovering a little above that 103 odd mark, but the dollar index has now moved to around 101.7 from emerging market perspective. Normally you see a weaker dollar index. That's good for emerging markets. So let's see how that plays out. But Amrish is still with us. Amrish, I wanted to ask you about a couple of these stocks that actually have seen a sharp correction. Z Enterprises as well as India Mart. Either of the two interest you? Because as we speak, both of them have moved to the high point of the day.
Z is one stock which I would surely recommend at this point of time because if you go by the last earnings, I mean, we are clearly seeing some uptick in margins, I mean, in terms of subscription as well as the ad revenues. And I mean, whatever issues were there as far as the management was concerned, to a large extent, it's been sorted out. So at these levels, after it's become 1/3 of what it was close to about 12 months back. I mean, at these levels, valuation-wise, it looks quite decent. Downside seems limited. I think the upside can easily be about 30-40% from here.
Okay, all right. You're thinking that there is enough of value. And in fact, the management commentary as well at the end of Q3 was fairly positive that for FY26, they're expecting margins to improve. The promoter entity came in there. They bought, I think, 0.2, 0.3% from the open market. All of that is encouraging. Let's focus on a couple of other names then. BHEL, I'm trying to look at some domestic-facing sectors. Any view on BHEL or Suzlon? Do you like either of the two?
Suzlon, I still think at these levels, it is still, I mean, decently highly priced. So I would not buy really fresh into Suzlon. In case of an upside, I would say those who have been holding since it was 8-9 rupees, I think it's still time to book some profits. BHEL, I would surely hold and possibly buy more on a decline, clearly looking at the sort of order flows which it has and more of that India-centric approach. I think, I mean, at levels of closer to about 195, 200, it makes sense to buy BHEL.
Okay, all right. Got that. What about Hitachi Energy? You know, I'm just looking at the exchanges. That's some communication that's come out on an HVDC order out there as well. The stock, remember, the last 2 years has moved from 3,000 rupees. It's moved up, I think, close to around 4 times because it's hovering around the 12,000 rupee odd mark. Hitachi Energy?
Nigel,
yeah.
I track this very closely, so difficult to give comments on this.
Okay, whatever. Let's focus on a few more domestic-facing themes then. Cement. You know, I'd done a presentation around 3 weeks or so ago. I said there's too much of uncertainty with regard to what's going on in the globe. And with cement, we're expecting demand to come back because now the capex spends is there. Housing demand is pretty okay is what we understand. Pricing in all probability has bottomed out and input costs have cooled off. Anything you like in particular? Any particular stock you like?
I mean, I also believe that this year cement should really do well because whatever said and done, the infra projects have taken off. I think execution, which was the key, I mean, should be really good in the current financial year. And along with this, looking at the way the input costs have come down, and there is clearly a delay between the demand increasing and the supply also increasing. So since a greenfield plant takes about 3 years plus to be built, I think there would be some sort of a gap there because of which we could see the prices also increasing. And that should be good for most of the cement companies. So Ultratech Cement is my best pick in this space.
Tejas Networks is a big mover today. That's up close to about 10%. There are reports which suggest that the company has got 61,000 crore of a 5G spectrum allocation. So the DoT has allocated spectrum to BSNL in certain 5G bands. And with this, the company will be able to launch 5G. Now, it's seen as a positive for Tejas Networks because BSNL had given the order to TCS and TCS had procured equipment from Tejas Networks for 4G. And even the company, Tejas Networks, in the Q3 presentation that they put up on the exchanges, had spoken about the opportunities that they're targeting, expansion of BSNL's 4G network and 5G upgrade and 5G's standalone network build out. So stock is quite excited in trade. And I think now Vardhaman Textiles is locked in an upper circuit of close to about 20%. So limit up on Vardhaman Textiles. Amrish, Tejas Networks, is that a stock that you look at? It's down 25% year to date.
Yeah, that's true. I think the correction was decent for this stock, and even the margins that come down earlier. I think that was one of the reasons why for the stock to correct. And I expect the margins to start moving up from here. So I think at the current levels, it can be bought.
Okay. All right, let's start wrapping up what has been a roller coaster day, and the end result actually is far better for India than many of the markets that have shut shop. Most of Asia has closed anywhere lower by 1 to 3.5%. Europe is down between 1 to 2.5%, and US futures are still down by as much as 3.5%. So contrast that with the Nifty's decline of less than 0.5%. It's not bad at all, and the mid-cap index is actually positive. So is the Bank Nifty. Let's pull up the Bank Nifty. It's up about 0.5% as we speak. So let's start with the good then. What worked? Clearly a move towards some financials, a move towards some PSU stocks, Power Grid, and of course Pharma was the sector of the day for obvious reasons. So Power Grid, Sun Pharma, Cipla, NTPC, BEL, these are some of the names which have seen buying. Some consumer names like Nestle also making the cut. Asian Paints on the higher side, Titan on the higher side. So Pharma, consumer and PSUs. That was the buying flavor today. On the flip side, IT took it on the chin because it stands exposed to a lot of US risk. So TCS, HCL Tech, Tech Mahindra, Infosys, big knock on these stocks. TCS is the worst performing stock on the Nifty, down 4% as we're closing out. Bajaj Auto, JSW Steel, Hindalco, these were some of the other names that were weak. Bajaj Finance, Kotak Mahindra Bank also on the lower side of the screen. Final tally on the Nifty at least is 90 points, but mid-caps actually closing positive, guys.
Indeed, mid-cap index up 0.2%, small-cap index up in the green, positive advanced decline ratio, 1,900 stocks gaining today compared to 750 stocks declining. Lots of other themes playing out. So textiles did well. So Vardhaman Textiles 20%, Trident, Gokuldas Exports ending with a gain of about 7 to 7.5%. The hope is that India emerges as a preferred destination for textile manufacturing. Lots of BFSI banking updates came through. IDFC First, ESAB Small Finance Bank, Poonawalla, AU Small Finance Bank. These are companies that came out with the Q4 updates. Stocks closed up in the green, 4-5%. And on the way down, Dabur was the big casualty on the back of their Q4 subdued update. We'll take your leave on this show, but don't go anywhere. After a short break, we'll be back with Markets Forward.